Hello and welcome to this fund update for the WS Amati UK listed smaller companies fund. And I'm Paul Jourdan, one of the fund managers. I'm here with Gregor Paterson, who is new as a fund manager to this fund, has been working with us for around over a year as an analyst and has recently become a fund manager. And we're here to introduce you to Gregor and to give a bit of a fund update. Before we start, I just point out there's a risk warning at the beginning here and a disclaimer, which is important to read through. So, Gregor, welcome to being a fund manager. Congratulations on taking on this role. It's not an easy time for UK small cap, as we know, and we're going to talk a lot about that. But before we start, why not just give us a little bit about your background and what's brought you to this point?
Sure. Good morning. I joined Amati in July of 2024. I had a 25-year apprenticeship. Before that, I was a smaller companies analyst, and then I worked in smaller companies, institutional stockbroking. So I've been active in the market for a long time and engaged with Paul and the team at Amati throughout that period. So I was delighted to get the chance to come and join the team. And I'm hoping that becoming a fund manager on the fund is timed for the UK market to start to catch up with some of its overseas peers, because we really are at a point now where it's a very unloved sector, and the growth companies that we look at are amongst the sort of cheapest that they've ever been.
Exactly. So I thought it might be an interesting place to start here, just to set the context and to carry on that point you were just making, is to look at this graph that is produced by our friends at Panmure Liberum, who are looking at the relative valuation of the UK stock market to the rest of the world. And they go back to 1986, I think it is, 1989, where this graph starts. And at that point, the UK was at quite a big discount to the rest of the world. For a long period since then, it was at a premium, actually, to the rest of the world valuations. And then very neatly, sharply reverses from June 2016. And I don't know if anyone can remember that there was a reasonably significant event that happened in June 2016. From that moment on, really, we've been having headwinds. And if you like, the relative valuation of the UK market compared to the rest of the world has been drifting downwards, and probably for the longest period any of us can ever remember. So this feels like a pretty extreme moment that we're in. Another interesting sort of valuation graph to look at is what we call the small cap discount, where you can look at the crude measure of P across the market. And for many, many years, the AIM market would have been at a big premium to the full list, partly because that's really where most of the growth stocks resided in the UK market, of the higher growth stocks. And some of those were high ratings. Actually, all of that premium is now gone. And it's growth stocks in particular which are being quite penalised in the London market. But the extreme nature of what we're seeing is pretty widespread. I think it's worth sort of standing back right at the beginning of this to sort of say, well, why do we invest in small companies at all, given that they're tricky animals, they're more illiquid, harder to deal in, it's more complicated investments in some ways. It feels like you're taking on more risk. Why do you do it? And the reason is simple, that there's a law of small numbers here, which means that small companies tend to be able to grow faster than big ones in the long run. And this is something that's been studied and carefully documented by the professors at London Business School over many years. And this is a slide that all small cap fund managers often refer to as their studies. And it's clear that the annualized returns of small companies are still, despite all those years of sort of sustained setbacks compared to large, in recent time, it's still at a very substantial premium return over the long run. And I really believe in this principle is not gone away. It's just stalled. And there have been other periods across this period from 1955 till now when it's also stalled. So it's not the first stalling we've seen. And in fact, the first time it stalled for a long period was late 80s, early 90s, just after the London Business School professors started the index. It stalled for about 7 years at that point. And there was a period of time when industrially, I think it was maybe mobile phones coming into being. There was some big industrial movements which really favored large companies. And in a sense, one could possibly argue that's a little bit of what's been going on recently, is that the AI mega trend, if you like, is really a big cap. It's starting out as a big cap affair, and it's primarily working to the benefit and question mark, but probably the benefit of the mega cap tech companies in the US. And obviously we've got to see how that's going to play out. But that's created a magnet for capital away from small companies, and small companies have looked like a little bit of a sideshow in this period. And it's been hard to get the sort of air of the oxygen that you need. And actually this phenomenon is also apparent in the US market, which has been very skewed to the large caps as well. But it's more extreme in the UK for other sort of overlaid reasons, geopolitical reasons, Brexit being a big factor in all of this in the long run. But also the 2 years in a row we've had delayed budgets and huge uncertainty over tax rises and so on. Just one more sort of thought on that in terms of what's changing. Is something changing about big tech? Well, obviously AI is a huge tailwind, has been a huge tailwind, and loads of money has gone into anything to do with AI at the large cap end. But one of the consequences of that is that US big tech is changing profoundly as a result of that, from being pretty capital light business models, very R&D intensive, to being capex heavy businesses, and staggering amounts of money are getting invested by those companies in data centers and power, the power required to drive them. So this is maybe the beginnings of something that might cause some change in the trend to come. And markets fundamentally are adaptive systems, and when one end of a market gets squashed, as ours has been, it very rarely lasts forever, and it somehow markets adapt, conditions change, and flows reverse. And so I think we have a pretty good level of optimism that we've kind of reached probably peak distress, if you like, in UK small cap. And it's going to take only a few relatively small changes of the wind to start creating a much more positive trend next year. So with that, Gregor, why don't I hand over and you maybe discuss a little bit of the way the portfolio is situated?
Well, I think we had a sort of false start almost in 2025, where the first half of the year we saw that the FTSE 250 and some of the growth companies in which we invest did start to mount a recovery and a catch up and join in with the larger cap peers. But round about the middle of the year, Q2, Q3, I think that gave way to fears over what was coming in the budget. Of course, that was going to hit sort of domestically focused stocks hardest, and that's the backbone of the mid and small cap universe. And we saw that pressure come through in share prices. I think the reason to continue to believe is that there is now a real gulf between the sort of large and the mid and small caps. Interest rates have started to come down. I think the budget did clear the way for that to continue. The next Bank of England meeting is on the 18th of December. I think as rates come down, the FTSE 250, this cyclical, domestically focused, consumer focused stocks always react to that. So we should start to see that as a theme as we go into 2026. And the fund is positioned to benefit from that. And that recovery will be led, as I say, by the cyclical, the house builders, the brick builders, some of the consumer stocks that we have within the portfolio.
Yeah, and the portfolio is now, we've got 46 holdings. We have a weighted average market cap of around 800 million, plenty of liquidity in the fund, It's become a relatively concentrated portfolio, and we think we can direct this at some what we call a myriad of opportunities. So the kinds of opportunities we're looking at really span several different types. And maybe if we just bring up our top 10 holdings here, it's a good way of sort of illustrating a little bit about the kinds of things that we're seeing in the market and the kind of opportunities there are, which we try to have a big range of different types of holding and different types of investment in the fund. And hopefully this is well illustrated in the top holdings. So you can see our largest holding at the moment is Trainline, which has been extraordinarily beaten up in the past few months. And this is what we see as a potentially world-leading UK company. It's been developing the leading travel app for really quite a number of, 15, 20 years. It's developed this market position. It's become the leading rail ticketing app in Europe. And we think its reach is going to go beyond Europe in due course. You can already use it to book trains in I think you were saying Japan, Gregor. You can book trains if you're going there, which would be remarkably helpful. I mean, curiously and somewhat surprisingly, the greatest rival to Trainline in the market has actually become the UK government. And it's a strange state of affairs when actually you've got the government sort of talking about setting up deploying public money to compete with one of the UK's most successful software companies like Trainline. But nonetheless, one could say, and our view is very much say that what's being created is a high level of uncertainty. So we all know that GBR is going to be taking over all of the train operating companies in the UK. And they are in the process of putting together a new app through which they'll sell their tickets. And that's, I think, created a backdrop of uncertainty for Trainline. It's one that we think actually this represents a pretty fantastic opportunity for investors in the company, partly because the price you're being offered to buy the shares already discounts a huge amount of success of the new GBR app. And actually, we think it's pretty likely that it's going to take longer to develop. It's going to be much more difficult for them to get it widely used by UK consumers unless they start adopting unfair competition. And actually, the consultations that have come out and the framework that's been set up will make it quite difficult for GBR to win through unfair competition. And in that context, we think Trainline should be able to maintain its leadership position and continue to grow really well in Europe. And beyond that, it's already also selling into the space of like corporate travel agents and a kind of wholesale market of intermediaries, an intermediary market, which has been very successful for them. So yeah, we think actually that the extreme position we're in at the moment is a very strong opportunity. So that's sort of one illustration. Gregor, why don't you come and talk about another example of what we have here?
I'll do two at once if I may. I mean, both Gamma and Ashtead Technologies are sort of leaders in their field. Gamma is in the telecommunications technology field, whereas Ashtead is a support services to the energy sector. The reason I'm flagging them both together is they've both gone through a very bruising move from the AIM to the main market of the stock exchange. That hasn't affected the underlying trading of the company, but it has caused some real indigestion as the sort of AIM, IHT funds that can only hold AIM have had to come out, and then we've had to look for replacement shareholders to take up those shares, and that hasn't really gone smoothly in either case, and it's created these really quite extraordinary valuations as these two companies settle down on the main list and in time, hopefully within the indices of the FTSE 250 to start with. But two sort of technical examples of things in the UK that are really badly beaten up for reasons that aren't linked to the underlying strength of the business. And the last one, if I may, right down at the bottom, Brickability, as the name suggests, is a a supplier, a distributor of bricks and cladding and building products. We're at the trough of the cycle at the moment. Usually these cyclical stocks at the trough of the cycle are on maybe 15, 16, even 20 times earnings, reflecting that the earnings will grow strongly as the cycle progresses. Brickability today is on just under 6 times, so there really isn't a lot of hope left in that share price, and that's really quite unusual, because Brickability has been through the cycle before. We know the pattern that the company will follow, and yet this time the market is giving them no credit for that experience, and very little hope in what could come next.
Yeah, and it's unusual to see in a sort of cyclical company like that, position where you have what we think are trough earnings and trough multiples. And normally when you've got trough earnings, you'd expect the market to anticipate some recovery, but really that's not happening at all at the moment. So yeah, and that's representative of one end of the portfolio, really, where there's a number of other companies in that position. And just to kind of finish maybe by covering the rest of the range of the kinds of companies we have here, Greatland Gold is an example of, actually the London market does contain some really outstanding mining companies. Maybe not very many, but there are some there, and Greatland Gold has been really a fantastic example of an Australian gold company getting put together in London. It's now joint listed. That primary listing is on the ASX in Australia. Fantastic growth prospects ahead. It's got a historic mine which it acquired from a major adjacent to its new asset which it wants to bring into production, called Jourdan. And they just published the figures on the Jourdan mine, which were, I think, very, very strong and very impressive. And we're expecting the Telfer mine, which is the historic mine they acquired, to have a longer mine life than is being forecast. And really, this has become a substantial gold mining business in a very good jurisdiction. And of course, that's benefited a lot from the rise in the gold price, which is an area that we can touch on in the range of things that we cover in the fund. And then maybe one final one. Boku is really an outstanding example of a growth company in the UK, and it's a global payments business, leading in its areas of operation. It operates in all manner of emerging market jurisdictions and main markets, and its main distinguishing feature is the fact that its customer base includes pretty much all of the world's largest retailers of digital IP and digital properties. And think of Amazon, think of Apple, Microsoft, Google, Netflix, Sony, for example, that sort of range of customers. And they have invested hugely in developing the kind of payment channels that these companies need in order to interface with 150 jurisdictions around the world, where many of which are difficult to set up all these payment channels in. And that's Boku is like a one-stop shop, which offers really slick payment processing in those jurisdictions. And we think it has very good sort of baked-in growth for visibly for the next 5 years. So it's a pretty exceptional company. And the one thing we've been waiting for to start coming through with that is margin expansion as the sales grow, and we're pretty confident that we're going to see some operational leverage start to appear in this business in the coming years. With that, I hope we managed to convey some of the excitement we have about holdings in the fund. We spend our lives looking at these things from the bottom upwards, and we find these. We're very excited about the kind of opportunities we have. Absolutely appreciate that we're in a market that's out of favour, in a fund where we've struggled with performance over the last 5 years, but we go into 2026 with really good optimism that these companies are going to start delivering for us, and aware also that if the market doesn't start coming back through attracting more capital probably from international investors, then I think that we're going to see plenty of these companies getting acquired over the next few years at significantly higher prices than they are now. So with that, I think we should say goodbye, and thank you for your attention. Very good to catch up with you. Please do contact us if you have any questions or would like to know more. Thanks.
Thank you.